In 2025, many investors faced substantial challenges and made critical mistakes that hindered their financial progress. One of the most significant errors was panic selling during market turmoil. Amid market volatility, particularly during the turmoil induced by tariffs, many investors succumbed to the pressure and sold their equities. This decision often led to locking in losses rather than allowing time for markets to recover. Historically, markets tend to rebound after sharp corrections, and by exiting positions, investors missed out on the key recovery phases, which hindered their ability to compound gains over time. Another prevalent mistake was overconcentration in single themes, especially with the massive surge in AI and technology stock valuations. Investors heavily weighted in AI-related equities frequently found themselves facing heightened volatility and significant drawdowns when market sentiment shifted or valuations corrected. This lesson underscores the importance of maintaining broad diversification rather than placing a narrow bet on one trend. Diversifying across various sectors and asset classes can significantly help in reducing risk and smoothing returns over time. Timing the market also proved to be a flawed strategy for many investors. Numerous individuals attempted to predict market tops and bottoms, buying at all-time highs or selling before anticipated downturns, but many got it wrong. This market timing is notoriously difficult, even for seasoned professionals, and often results in buying high and selling low. A better approach for investors is to adopt a consistent investment strategy, such as systematic investment plans, and focus on long-term holding. Over the long run, consistent investing tends to outperform short-term trading driven by market timing. In 2025, investment decisions often leaned heavily on emotional responses and herd behavior, particularly among inexperienced investors. Social media played a significant role in promoting herd sentiment, driving many individuals toward crowded trades and leading to avoidable losses. Buying during euphoric rallies and selling during moments of fear highlighted how emotional decision-making could derail sound investment strategies. Many investors exited the equity market en masse during risk events, even when long-term fundamentals indicated that their investments remained solid. A crucial mistake for numerous investors was neglecting diversification and liquidity needs. Some individuals were overly concentrated in equities or a single region, such as US tech stocks, without incorporating other asset classes like bonds, gold, or diversified international exposure. Large drawdowns in the market underscored the need for uncorrelated assets to help smooth overall performance. Understanding that diversification involves owning not just many stocks but truly different return drivers is vital for managing investment risks effectively. Chasing yield without fully grasping the associated risks was another common pitfall for investors. The allure of high-yield investment products, like options-based income ETFs, enticed many with attractive payouts. However, these products often came with hidden risks and complexities that could lead to poor total returns over time. Investors must exercise caution and perform thorough due diligence before pursuing high-yield opportunities, ensuring they understand the potential trade-offs involved. Currency risk and macroeconomic factors also played a crucial role in investment returns during 2025. The sharp decline of the US dollar, for example, illustrated how currency risk could significantly impact returns, especially for those heavily weighted toward USD-denominated assets without proper hedging strategies. Investors need to be aware that currency shifts can either boost or drag down returns, independent of the underlying asset's performance. Understanding the interplay between currency fluctuations and macroeconomic conditions is paramount for successful investing. Another error committed by many investors was freezing during policy and geopolitical shocks. Events like sudden tariff announcements triggered significant market volatility, and many investors responded by halting their contributions or exiting assets prematurely. This is a misguided approach, as taking a moment to assess the economic fundamentals behind such shocks can provide clarity and prevent hasty decisions. Pausing disciplined investing during times of chaos can mean missing out on substantial rebounds when the market stabilizes. The most fundamental mistake seen in 2025 was failing to understand the assets or sectors in which one was investing. Putting money into complex ETFs, leveraged products, or trendy stocks without truly comprehending their underlying mechanics led to emotional reactions when the outcomes deviated from expectations. Investors cannot stress enough the importance of investing within their circle of competence and conducting thorough research before making any investment decisions. As we reflect on the investment landscape of 2025, several key takeaways emerge for future investing. Firstly, investors should avoid panic selling. Instead, they should ride out volatility if the underlying fundamentals of their investments remain intact. Secondly, diversification should be viewed holistically, encompassing not just a variety of stocks, but also different sectors, geographical regions, and asset classes. Moreover, sticking with a systematic investment approach rather than attempting to time the markets is crucial. Evaluating assets based on solid fundamentals instead of fleeting buzz or hype will lead to more informed investment choices. Additionally, managing emotional and social media biases will help maintain a rational perspective in decision-making processes. Lastly, understanding the potential impacts of currency and macroeconomic factors on returns is essential for navigating the complexities of investing in today's environment. By learning from the mistakes of 2025, investors can equip themselves with the knowledge and strategies necessary for successful investing in the future.